Welcome back. In this week's Tax Time segment, we are breaking down the tax implications that stem from that $1.9 trillion American Rescue Plan, and a lot of headline attention gets placed on the stimulus checks. We know a lot of Americans are excited about those, but let's not overlook the child tax credit as a piece of this bill, as well as the fact that the way that Americans will have to pay taxes on unemployment benefits has completely changed now. So here to break that down for us is our next guest in Tax Time, Bill Smith is CBIZ MHM's National Tax Office Managing Director. He joins us now. And Bill, I mean, when we look at it, that was one piece that Americans were concerned about, the fact that they'd have to pay taxes on those unemployment benefits. So what should individuals know who maybe tapped that throughout the pandemic now that this bill has been passed?
Well, it's a great topic because it caused a little bit of confusion. Previously, stimulus checks were not taxable, unemployment was taxable. So with this new bill, the ARP Act, unemployment is extended through Labor Day, set at $300, and it is going to be tax-free for the first $10,200 of unemployment benefits that you receive. After that, it will be taxable still. But for those in the most need, those amounts up to $10,200 are going to be tax-free regardless of your other potential income during the year.
The child tax credit one that Zack hit on earlier is certainly going to be affecting a lot of families when you talk about checks of up to $300 per child. What are the implications from a tax perspective for that?
Oh, that's a great credit for those in need. It bumps it way up. There was a child tax credit. And remember now, there are potentially two credits at play here, the child tax credit and the credit for sending your kids to daycare, possibly. So the child tax credit, if you have a child 0 to 5 and you're in the qualifying income group, you can get a credit of up to $3,600 over the course of the year. And that, if you qualify, based on what we know from your 2020 tax return you filed, is going to start hitting your bank account as early as July. So the way they've structured it is half of it is intended to be paid in periodic payments starting July, and the rest of it you'll have to claim on your tax return when you file your 2020 tax return, your 2021 tax return in 2022. The dependent care and child care credit also got boosted way up. So now you can have qualifying expenses up to as much as $8,000 with potentially 50% of that amount as a credit. So you can get a credit of up to $4,000 for childcare, which is a big increase over prior years. That, unfortunately, you're only going to get when you file your tax return. So you're going to have to fund that amount up front, but then get it back when you file your tax return next year.
Yeah, and one of the other pieces of this too is, of course, on the business side too. We've been talking about, the key differences between what people on the individual side should know, and then also what businesses are doing with the employee retention credit piece of this bill as well. How much of that changes things on maybe, kind of the employment side of this picture moving forward in the recovery?
Well, it's fantastic because the benefit to employers has skyrocketed to about 560% of what it was in 2020, which is going to give them much more money to keep people on the payroll. So last year you had a maximum amount of qualifying wages of $10,000 with a 50% credit, so you had a $5,000 benefit. With the combination of the Consolidated Appropriations Act signed in December and the new stimulus package, that amount goes up to $28,000 of credits a year because you get $10,000 in qualifying wages per quarter instead of per year. That means $40,000 for the year and a 70% credit instead of a 50% credit. So you're getting $7,000 potentially per employee per quarter, or $28,000 per year. Now you can't use the same wages. You can't use the same wages you use to justify PPP loan forgiveness. If you've got loan forgiveness of a PPP loan, you can't use those same wages. On the positive side, when the ERTC was originally passed, if you applied and got PPP loans, you were ineligible for the credit. That was taken away retroactively, so people can go back to 2020 and recoup ERTC credits based on their qualifying wages, regardless of whether they got PPP loans or not.
Yeah, and qualifying wages is important on the individual side too. When we talk about, people who might be looking at filing taxes here in that threshold, around 70,000 for individuals and stimulus checks. We've been talking a lot about when might be the right time to file. What would be your advice to people out there trying to figure out if it makes sense to file now versus maybe later after the stimulus checks? What's that timeline look like?
Well, because the stimulus checks aren't going to be taxable, it's kind of the same advice as you would always give. If you're going to have a refund, file yesterday. If you're going to owe money and you don't have any kind of penalties that are going to apply, you might as well push it out and hang on to your money as long as possible.
The advice stays the same there. Bill Smith, CBIZ's MHM's National Tax Office Managing Director. It's good to talk to you today.